You have a suite of ETFs. There's a series of it called enhanced, quote unquote, ETFs. Tell us a little bit about them. Do they share a common investment strategy or investment approach? Are they all focused on this managed risk approach that's proprietary to SGI? Share some intel on these strategies.
Absolutely, I'd love to. Our ETFs are an extension of that same managed risk philosophy of preparing before the storm. Now, they do have different mandates, whether it's, like you just mentioned, dynamic tactical to, say a large cap growth or something like this. But each fund is designed to provide investors with, obviously, transparency. We love that about ETFs, but also rules-based access to this managed risk for our clients. So whether it's U.S. equities or global equities like you talked about, or the common thread here is this risk awareness, and that we want investors to have these tools that align with their actual experience in the markets, focusing on not just returns, but again, managing that ride. So in the dynamic tactical, this is one where we know that if you look at it from an attribution standpoint, most of your returns are attributed to the asset class you're invested in. So on the margins, can you be in the right place over time? And that's really what that strategy is trying to do. So it will use stocks, bonds, and cash exposure to be able to help investors to be in that right place. It's not meant for 100% of a portfolio. It's meant to have that, if you will, that tactical, that leaning into some of the things that are going on. The enhanced products are a little bit different. Use options to create alternative or enhanced income. Whether you're in global, that might have an underlay of global stocks with an enhancement of options over that, or enhanced, depending on what space you're in, it will have more enhanced income, is what it's seeking anyways, over the underlying exposure. So that's the idea behind the enhanced product. So if you're looking for a NASDAQ 100 exposure, for example, this would give you that exposure to the NASDAQ 100, but then seek to enhance that exposure by some options income that is kind of an alternative way. The interesting thing about option income is that it has a very low correlation to both stocks and bonds, whether it's like the Bloomberg Aggregate Index, for example, or the S&P 500. Options can tend to have a diversification effect for the portfolio. Investors use our ETFs in various ways. Some of these use them as core holdings, more of a risk managed way to stay in the market. Others are very tactical, like I mentioned, with dynamic tactical.
What key trends are you looking at? Any big macro view you want to share, or areas of the market that you think are really interesting, either as an investor or as an opportunity for product development? What's on your radar?
Well, there's a couple things that everybody's radars kind of have somewhat of attention to. Inflationary pressures is a big one, right? The Federal Reserve's another one, the shifting interest rate expectations that's going on, the growing role of AI and all the automation that's happening, and the CapEx that's anticipated to be spent. So all of those things are there. Geopolitical risks are out there. But let me talk a little bit about some things that maybe people aren't thinking about. So in the days in the past, we knew that the stock market was probably one of the most risky things, right, that people invested in. And we had these things that everybody referred to as bubbles, where we would get into them and they would just have this humongous amount of investment into them before the bubble popped. And so we've seen the great financial crisis in 2008 and the tech, if you will, bubble in 2000. All of these things are examples of what I'm talking about. But now we have a lot of that risk exposure outside of the market. Crypto, for example, is an area where a lot of people have invested their more risky part of their portfolio. And one of the reasons why I think the market's different today than it has been in the past is that it is not the only place to have risk. Consequently, the bubbles don't seem to be getting as big as they were in the past, nor are they popping as much as they were in the past. And this is an interesting phenomenon that I think people need to consider is, what are we investing in, and is it the same as the past? And my argument would be no, it is not. So how do you maintain the ride? Maybe it won't be as bumpy if these bubbles aren't bursting as much as they were in the past, but it's still a roller coaster. And that's where really these enhanced type of products or a managed risk approach comes into play. And so how do you manage in this new environment in the stock market and bond market and these liquid markets? I think you have to have a new approach, and that's what we bring. So from my standpoint, those are some of the trends we're looking at. Is how's the market changed? Yes, absolutely. Inflation and Fed and the normal things everybody's looking at, like the AI trade. But there's an increasing demand to strike a balance for investors between growth and resilience within their portfolio.